There's never been this much division on the Federal Reserve Board, on the Federal Open Market Committee. And yet there seems to be this concerted effort to prevent any dissent from escaping from the Eccles building. And it's been an extraordinary sight to behold, to watch Jay Powell keep his caucus together as one group. He suffered, one dissent on the part of Esther George last year. She was advocating to slow the pace. But other than that, given what we know about the true personalities and leanings of the individuals, it's extraordinary that we have not seen more dissent, given how divisive a group they are. I mean, I will be right there in 5 years' time, hopefully on a beach in the Caribbean somewhere. Anyway, in 5 years' time, I will be anxious to read these transcripts when they are released, because they will reveal, I think, more of the truth and honesty that's going on around that table, because I would say that at least 50% would advocate for halting quantitative tightening, for halting the rate hikes, for beginning to plan on easing. And yet that's not what we're going to see this year. I think that they are prepared to pause. I think that they don't want to do that until after they raise 3 more times. So I think that they want to have that last quarter point hike come through at the June meeting. And then I think they want to pause and hold rates where they are. In other words, I go back to what's most important here, and that is, are they going to defy markets? A little bit of history. October the 6th, 1979, Paul Volcker had been in office for 2 months to the day. It was the Saturday before the Columbus Day holiday, and he called a press conference at the Eccles building on a Saturday evening and said, we're going to change the way that we conduct monetary policy. Thank you for your time. Goodbye. I mean, the market absolutely collapsed in the days that followed. He didn't come out on the evening news until that Thursday that followed and just let markets interpret the Fed moves as they would, as opposed to doing what the market deemed. That was the last individual that did that. Whether you're talking about, especially Greenspan, Bernanke, Yellen, and Powell up to now. If markets price in, say, 75% or more chance of a move, whether it's easing or tightening, the Fed has always gone in that direction. So pricing in something that the Fed is going to defy is an extraordinary event in the last 40 years of monetary policy history in the United States. I think that pricing is also telling you that if easing does not commence, that something is going to happen. And that is market's duty. It is to price this in and to look back, especially as a percentage of the Fed funds rate, because starting points matter, deltas matter. So even though we were coming from a very low base, we've actually tightened more than Volcker tightened, going up to 21%. On a percent, I put a little chart out there for you. It's extraordinary, and yet we haven't had a financial event. We haven't seen credit spreads misbehave. And what's missing from the calculus here is that the idea of transitory and this huge policy error on the Fed's part in insisting that inflation was going to be transitory. What if they knew that it was not going to be transitory in the space of months, but also knew that if they kept zero rates at the zero bound, that they would afford corporations the opportunity to extend the maturities of their debt obligations such that they could withstand a future tightening cycle, and the financial event that threatened in 2018, 2019 would not recur. And that's Jay Powell. He founded the Industrials Group at the Carlyle. He understands hedge funds, private equity. He understands that there's massive risk in the non-banking sector. But giving companies time to extend out that debt has really benefited in terms of financial stability throughout the hiking cycle that started last March. I think what people don't understand, if you listen to the president of the National Bureau of Economic Research, which for half a century has scored recessions in the United States, they emphasize that a technical recession is not a recession as they define it. They also in August of last year, they pointed to the example of July of 1953, when the unemployment rate was 2.2%. And yet that is when they said recession began, even with the unemployment rate as low as it was. By December of 1953, the unemployment rate had risen to 3.6%. But the reason that the president of the NBER pointed out that episode, I think, was a warning of sorts to say we could say that we're in recession, even though Federal Reserve officials insist that until we get verification from the employment data, we cannot be in recession. The NBER is saying, no, that's not the case historically. Historically, we can call recession before, and it goes back to industrial production, real income, net of government transfers, real personal consumption expenditures, and employment. Those are the four major barometers that they test to score recession, the largest of which is private demand, right? The aggregate of consumption in the United States, 70% of U.S. GDP, and business investment. If you look at that one particular line item, it has been at 17.7 trillion on an adjusted basis for 5 quarters, save the 17.78 that is currently estimated for the fourth quarter of 2022. We don't have that data in hand. But 17.7, 17.7, 17.7, 17.8, estimates for Q1, current quarter 17.7. I think what people should appreciate is that by the rights of the NB, they could score the recession as having begun in January 2022. And yet we split hairs trying to say, is it going to be the second or third quarter of 2023? When the numbers, they do not score recessions based on GDP growth. They score recessions based on real levels of output, dollars. And there's just a fundamental misunderstanding in the economics and investment community about how the NBER operates. The NBER was very careful to point out, well, we can't score the recession after 2 negative prints in Q1 and Q2 of 2022 because net trade was the big swing factor, and that's just GDP math. By the same token, what would GDP have been in the third quarter without net trade? And so that's one of the other reasons that they've been so quiet. But if you drill it down to that one line, real private demand, you see that the U.S. economy has been in a steady state of stagnation for 5 quarters. It's a very, very long time with the unemployment rate at a half-century low, with announcements coming out of Silicon Valley as if they cannot control their stomachs. It's like, gosh, my competitor just announced 10,000. I must announce 12,000. And people are saying it's a white-collar recession. It really doesn't matter. Guess what? I'm hearing from home builders. I'm hearing from the manufacturing sector. I'm seeing business closures across the broad economy, that these layoff announcements, and we will get to hear about them in forward guidance because companies tend to throw the baby out with the bathwater. So they're going to shove all of the bad news into forward guidance in the fourth quarter earnings season, and that is going to be accompanied by layoff announcements that are well beyond Silicon Valley. So my point of that chart is we see this 17.7 trillion before we really see the damage inflicted by lost income.